Iron trades.
Welcome to the next Trader Fundamentals lecture, understanding liquidity, stop hunts, and market traps, how smart money moves price, and how we're going to trade around it. First thing is housekeeping. Nothing in this coaching constitutes financial advice. Everything is intended for educational purposes. Lessons will be recorded, and coaching is a self-driven educational partnership. No specific trading results are guaranteed. As always, here is our candle charts. I advise everyone to familiarize yourself with the setups that are most pertinent to your strategy. You do not need to know all of them, although over time you'll likely learn them. I advise learning a handful of bullish and a handful of bearish ones until you know them back to front. What is liquidity and why it matters? So let's get this straight first. Liquidity is not just a buzzword, it's the heartbeat of the market. In real terms, liquidity is just volume, the willingness of others to buy or sell at specific prices. But more importantly and more specifically, it's resting orders, buy and sell orders that sit at key levels, waiting to be triggered. These include stop losses, limit orders, sometimes iceberg orders from big players. But the kicker is institutions, hedge funds, and anyone moving big size can't just randomly enter or exit. If they do, the market will move in the opposite direction, or move against them, and they'll get bad fills. They'll move the market against themselves, essentially. So what do? They go where the volume is. They need liquidity, and they know where retail hides it. Just above prior highs or lows, just around stop losses and breakout buy stops, just below lows, hunting for stop losses on longs, around the VWAP, that's programmed mean reversion, and around round numbers, psychological levels. The market moves to these areas because that's where business gets done. That's where big trades get exchanged. And that's why you'll often see price run to a high, grab stops, and then reverse instantly. It wasn't a breakout, it was a liquidity sweep. And if you want to understand price movement, you have to forget the indicators for a minute and think like a shark or a market maker. You ask yourself, where is the blood? i.e., where is the liquidity? Stop hunts explained, the mechanics behind the pain. Now let's dive deeper into one of the market's favorite tactics, stop hunting. Stop hunts are intentional. They're designed to punish predictable behavior, and most retail behavior is extremely predictable. A stop hunt works like this. Price pushes beyond a very obvious level. Maybe it's yesterday's high. It triggers a wave of stop losses and breakout orders. All that order flow floods in, and then guess what? It gives the other side of the trade what they needed, which is liquidity. This is classic smart money behavior. They create movement to generate volume. Then once they've collected enough liquidity, enough of this movement, they reverse the move. So how do you recognize it in real time? The move is often fast and sharp. You get a big wick with little to no follow through. The breakout does not hold structure. It fails quickly. And it often happens around high volume windows, like the bell at 9:30, 10 a.m., later in the day at power hour. If you've ever said, oh, I got stopped out and then it went exactly where I thought it would go, which, if we're honest, we all have, that means you probably got stop hunted. The trick is learning to expect it, not fear it. And we can talk later in this presentation about how to use it to your advantage. The anatomy of a trap setup. So let's zoom in on trap setups. These are gold if you know how to spot them and use them. A trap is when the market gives you a fake signal. It invites you in, it gets you committed, and then it yanks the rug, or it rug pulls you. That's the definition of a trap. It provokes a position and then reverses aggressively to take advantage of you. There are a few common types. Breakout traps, which is when price breaks out and then immediately reverses. There's reversal traps, which looks like price is turning, often off a support level, but it's actually bait and it continues. News traps, big moves on a headline, and this is very common for JOLTS, FOMC, CPI, and PPI. So it'll be a big move on the headline and then reverse within minutes. And the anatomy of a trap often looks like this. Break of a key level and it looks legitimate. Then small indecisive candles right after the break, no real follow through, no real volume to follow up, and then a big rejection wick or an engulfing move sending you back into the range. Usually, the movement of clarity is when structure breaks in the opposite direction, and that's when you know this wasn't a real breakout, it was just a liquidity sweep. The key to profiting from traps is simple. You don't be the first one in. You be the one who waits for the breakdown. You watch the behavior and you fade the failure. Liquidity zones. You must mark these every day. So we talk prep work here, because if you're not marking these zones daily, you're trading blind. These zones are where traps and stop hunts live. You don't need to guess. Price will literally tell you where in the action these things are going to happen. So the checklist is overnight highs and lows. Global traders leave their resting orders at these levels. Initial balance range, which is the first hour of regular trading. So it sets the tone for the session. Previous day, high, low. Common trap areas due to retail anchoring. So that's a bias that retail has. VWAP and one standard deviation band on either side, which is algorithmic trading uses these for mean reversion or trend continuation. And gap edges, single prints, so very thin areas in the volume profile which attracts probes. And if you are hunting the 1 minute gaps, a lot of the time you'll see price return to the top of the gap and then reverse. And common sense would say it should fill the gap, but it's actually where a lot of the trap buyers or sellers are waiting, and the gap will remain unfilled. So you're not trading these levels blindly. It's not a guarantee. There's nothing in the market that's 100% hit rate. They're not signals. They're the zones of interest. So you wait for price to hit one of these areas and show you whether it's a rejection or it's a reclaim or it's a trap or it's a true breakthrough. If you get good at this part, the prep, then your decision making becomes a lot easier during the session. You're no longer guessing, you're reacting to these zones. How to trade around liquidity or liquidity traps. So this is where it gets a little bit more real in terms of trading. How do we trade it? Let me give you a few high conviction rules. And these help make things a little bit more predictable. Don't chase breakouts. If you didn't anticipate the breakout before it happened, and you're just trying to buy in after the candle close or after the breakout, you're probably going to act as someone else's liquidity or exit liquidity. So let the breakout happen, let it trap people, wait for the reclaim, and that's when price is coming back into the old range, and then now you've got your new setup. And keep in mind, if you miss a breakout or you miss a setup, there's always going to be another one. The market is open. Today, tomorrow, every day, there's always going to be another opportunity, so you don't need to always chase them. Next rule would be paying attention to the wick. Wicks are rejections, either side, up or down, especially at key levels. If you see a long wick followed by a reversal candle, you may be looking at a stop hunt, especially if the wick is backed by a sudden volume spike. And then finally, volume tells you who's in control. Volume is something that can't be faked. So breakouts with no volume, it's not a real breakout. Wicks with heavy volume, that's an actual rejection. Volume is a lie detector, so watch it closely. So tips for entries in these areas. Look for the reclaim entry. Price breaks down, comes back above the level it faked through, and then reclaims. Fade the second test. It's often called a failed second attempt, obviously. And then use candle range theory. Enter off the mid bodies or the reaction candles with risk defined at the wicks. So you don't want to be reacting emotionally, you want to be responding to behavior. Real examples of stop hunts and traps. So put this into context. Say, for example, you're watching ES. You see price break the prior day high with a surge. So it's a breakout. Now breakout traders are jumping in. There's volume flooding in going long. Then suddenly a huge wick forms. Price collapses back below the high, the previous high, and volume explodes on the reversal. That's the trap. Just played out. All the breakout traders flooded in, price reversed, now they're trapped above. They're trapped in the red. You don't want to be chasing it. You want to fade the reclaim. Another example, say you're trading gold, GC. You get a lunchtime pop above VWAP, but there's no follow through. The next candle is a spinning top or a doji. Then a big red bar flushes the move. It's a classic low volume trap, especially in that lunchtime period. You see the same behavior at the edges of gaps, where price will spike into a low volume zone, stall, and then get rejected hard. All of these share one thing. The trap comes first, the move comes second. If you're patient, if you wait for that confirmation, your entries become cleaner, tighter, your risk gets smaller, and then you are able to realize much more upside. Final takeaways. Trade with patience and react with precision. So now we understand how the market really moves. It's not random, it's not magic, it's not guesswork. It's all about liquidity. And whoever controls the most volume wins. And that's true on every level, granular up to the macro. So the mindset shift you should be looking at is don't be the liquidity. Be the trader who waits for liquidity to get swept and then enters. Don't guess direction. Identify zones and let the price show its hand. Which way is it going to go? And don't react emotionally. React to structure, volume, behavior. If you can master these, if you can truly wait for traps, just let them play out and then trade the reaction, not the bait, you'll level up much faster and you'll end up realizing much more profit. And this is how you turn chaos into consistency.
Iron Trades.